Hi, it's Chuck Bolton. In this lesson, we'll be talking about how the cash flow statement works. Although it's quite tricky to understand at first, by the end of this lesson, you should be able to make and analyze cash flow statements like a boss. But first, we have to understand what a cash flow statement really is. The cash flow statement is one of the big three financial statements that can be found in every company's annual report, with the other two being the income statement and the balance sheet. The cash flow statement essentially uses information from those two other statements to show the inflows and outflows of cash in a business throughout the year. We all know that cash is one of the most important asset accounts for all businesses, or the most important, due to how it impacts the company's liquidity and profitability. With more cash, businesses are able to finance purchases and pay down their debts easily. Therefore, it would benefit everyone if there was a way to figure out where the cash is coming from and where it's going throughout the years. Investors would be able to use that information to make more informed decisions about their investments. Creditors would be able to see how capable a company is to repay their loans, and so on. The cash flow statement serves this purpose and acts like a gateway into seeing what transaction makes up the cash account found on the balance sheet at the end of the year. All right, now we can get into the slightly more complicated part of this lesson. How do you make a cash flow statement? Well, first, we need some information. To create a cash flow statement, you need the recipe of comparative financial statements, basically balance sheet, for the last 2 years, the income statement for this year, and any additional information about any of the transactions throughout this year of note. Additionally, there are two methods of making a cash flow statement. For this course, we will actually be focusing on the indirect method, as the direct method is time-consuming and involves going through every transaction a business makes throughout the year. Both are recognized by GAAPs and the IFRS, so either method works. All right, let's get into the important stuff. There are three main categories found on every cash flow statement. First, there's the cash flow from operating activities. This category accounts for cash generated and lost from the operation of the business itself. To calculate the total cash flow from operating activities, we actually need to adjust net income from being a accrual-based number to being a cash-based number. So what do I mean by that? Actually, don't worry, you'll see later. Next, there is cash flow from investing activities. This involves the purchase of long-term investments or assets and the sale of current fixed assets and investments. Lastly, there is cash flow from financing activities. This category involves financing transactions such as the purchase of equity or cash generated from the issuing of shares. Here is an example of what a cash flow statement should look like. You can clearly see the three categories and how they're structured. Let's focus on the first category, being cash flows from operating activities. So remember how I talked about changing net income to being cash-based? Well, here is the way to do so. First, all the non-cash accounts that affect net income, amortization expense, accounts receivable, accounts payable, so on, so forth, need to be adjusted in a way to give us the cash amount we received from the operation of the business. So, for example, we know that amortization expense doesn't actually decrease the amount of cash we have, as it's related to the depreciation of an asset we own. Even though this is the case, amortization expense still decreases net income. Therefore, we must make an adjustment to add back the amortization expense, as that would give us an accurate representation of our true cash flow. Here's the net cash flow from operating activities from the example given prior. Notice how the amortization expense account is actually positive. Next, cash flow from investing activities. This category is actually pretty simple, as it deals with the sale and acquisition of fixed assets and investments like bonds. No tricky business here. Equipment with a market value of $50,000 would decrease the amount of cash we have by $50,000. Finally, cash flows from financing activities. Cash gained from the issuing of shares and cash spent on repurchasing equity belongs in this category. Again, this should be pretty simple. If you, let's say, issued $50,000 worth of shares, then you are expected to have a positive gain in cash by $50,000. Lastly, I just want to go over the total cash flow equation. This just involves totaling the three categories and indicating how much cash was generated/lost by the business. This account is then added to the cash from the beginning of the year to get the cash flow at the end of the year, which should match the cash account found on the balance sheet. All right, returning to our example, here is our total cash flow, and here is our cash flow at the end of the year. Now, I hope that all makes sense. I went pretty quick, but I do have a golf lesson to catch. So I'll leave you guys off with my good pal, Mr. Conrad Fisher. He'll be talking about the significance of the cash flow statement and providing some unique examples of a cash flow statement. Bye-bye.
Thank you, Chuck Bolin. Today I'm here to talk to you about the significance of the cash flow statement. As stated prior by my wonderful friend Chuck Bolin, why should you understand the cash flow statement? Well, the cash flow statement is an important step in showing the financial health for a business, the information it provides, or how the business moves cash around and what it spends it on. If you are able to learn and understand the cash flow statement, which you should already know, then it can aid in important investment decisions. Now, speaking on these decisions, for investors and shareholders, it can help with providing important information on if they should invest with the company, stay with the company, or move on from the company. But the cash flow statement is an invaluable asset for anybody with any relation towards the company. For managers and executives, it can help with the budgeting from one accounting period to another. And for owners, it can provide insight on how the company is spending and receiving money. Now, moving on to our unique example, I'll be using my favorite company, Costco, and their cash flow statement. I'll be looking at it from an investor standpoint and what I would pick apart and what you should pick apart, and some things you can analyze from this. Starting with, first of all, you have your three categories: cash flows from operating activities, cash flows from investing activities, cash flows from financing activities. Starting with net cash provided by operating activities. As you can see, in 2021, Costco roughly has $9 billion. And in 2023, Costco has a substantial amount more, in $11 billion. This shows that they have strong operational efficiency. Now, that's not the only growth that you can look at. As you can see here, towards the end of the statement, in cash and cash equivalents end of year, Costco in 2021 had $11.25 billion, and in 2023 they had $13.7 billion. This shows that Costco has a lot of liquidity for future endeavors, which as an investor would be like, Costco has a lot of money that they can spend on potentially more assets. They can buy businesses, they can buy more land, they can buy more buildings. But that's not really all you can really look at. There's some more things, specifically in merchandising inventory. As you can see here, it's a negative number, and here it's a positive number. This shows that Costco is able to sell their stock. As an investor, you can be like, they sell all their stock. That means they have a strong consumer base. That means that they're going to keep on going for a long time. Maybe I should invest. And similar, speaking on what I said, where it's an invaluable asset, not just with investors. You could, as a manager or an executive, see that, we sell our stock out so quickly. We should add more money so we can buy more stock. And for owners, they could see this and be like, we make a lot of money off of our stock, or the company makes a lot of money off of our stock, which means I make a lot of money on our stock, which means we should maybe try and branch out into more areas to gain even more profits off of our stocks. And that's just a few things that you could look at. Thank you to me and Chuck Bolton for explaining to you how the cash flow statement works. Now that you know how it works and understand the significance, you can work on the exercises, which you can find in the syllabus under the current lesson block. Thank you.